Hello and welcome back to usareversemortgages.net by iReverse Home Loans. My name is Brandon Webb. I'm your reverse mortgage expert. Today I want to take a quick minute to talk about adjustable rate reverse mortgages versus fixed rate reverse mortgages. Most people out there don't know the difference, and they are vast in regards to reverse mortgages. Obviously, everyone wants a fixed rate. A fixed rate is fixed. It always stays the same. It will never change. It's reliable. A lot of people are afraid to take adjustable rate loans because the rate can do just that. It can adjust. It can go up. Obviously, you wouldn't be worried about it going down, but it could go up. With the reverse mortgages, though, there's a big difference between traditional mortgages for fixed and adjustable. With a fixed rate reverse mortgage, the borrower is given a lump sum of cash, and that's it. You have to take the money that you are allotted with the reverse mortgage in a lump sum. There's also some money that you could have obtained later with an adjustable that you will lose out on. So they'll give you that lump sum of cash, and they'll immediately start charging you at that fixed rate. Most rates are around 5%, anywhere from 4.75 to 5.06, some even higher. They're going to give you that lump sum, start charging you on it right away. If you do want a payment plan, such as a line of credit, a term payment, or a 10-year payment, which is a guaranteed payment for the rest of your life monthly, you would have to take an adjustable with a reverse mortgage. The fixed rate only offers that lump sum. Most people don't like that. Most people would prefer to make that choice on their own. The good thing about the adjustable rate reverse mortgages is they do have a relatively low cap. The lifetime cap on these loans is 5% above the start rate. Most of the start rates are anywhere between 2 and 3%, maybe slightly higher than that. So obviously, it's a pretty low rate compared to most HELOCs today, around 18%, and there are no fixed rate HELOCs. So people don't realize that when they think of a HELOC versus a reverse mortgage, and they think, well, I don't want an adjustable, and I would have to take an adjustable to get the line of credit I want. Taking a HELOC will come due at some point, first of all, while you're still living in the home most likely, and it can have caps as high as 18%. Reverse mortgages are much lower than that, and those ARM reverse mortgage products do allow you to take a line of credit, take a term, take a tenure. If you take a line of credit with a reverse mortgage, any money that's sitting in that line of credit you're not being charged for because you haven't spent it yet. As soon as you take a portion of that money out and do spend it or put it in your bank account, do whatever you're going to do with it, then they can charge you interest on that. But anything sitting in that line of credit you can't be charged interest on, and it's actually growing at a rate that matches the current interest rate. So if your current interest rate, let's say, is 3%, that means that the lender is charging you interest, 3%, on anything that you've spent. But anything in the line of credit is growing at 3%. Okay, now everyone says, well, that sounds too good to be true. Why would they pay me money to leave money in there? When we say it's growing, it is growing, but all it's doing is giving you access to more money. So for instance, if you put $100,000 in your reverse mortgage line of credit, and after a few years it's grown to 120, and you spend 120, well, then you owe 120. Okay, so to be very clear on that, it's not earned interest like a CD. It's just giving you access to more money over time. That being said, to a lot of people that sounds more desirable than a fixed rate, because with that fixed rate, any money you qualify for, they're going to make you take as a lump sum and immediately charge you interest on all that. With the adjustable, you can put part of the money in the line of credit, and on top of that, after the first 12 months, you'll have access to more money. The government recently has decided to pace the way seniors can spend the money on reverse mortgages. So they'll give you a lump sum of money that they're going to let you do what you want with, but they'll only let you spend 60% of that in the first year, and then the additional 40% after that, unless you need more than 60% to pay off a mandatory obligation, such as another mortgage that's on your home. If you take a fixed rate, you're only going to get that first 60%. That additional 40% that they were going to give you a year later remains as part of your equity. You don't get access to it. The other downside to the fix is if you decide that you don't need all the money that they're giving you and you pay some back because you can, there are no prepayment penalties with the reverse mortgages, you can't get that money back out. Once you've paid it back towards the loan, it's gone. Your loan amount is lower, and that's a good thing, but you can't pull it back out if you had to. If you do take an adjustable rate reverse mortgage, and let's say you have a line of credit, you decide that you don't need as much money as you pulled out. Let's say you pulled out 20 grand and you go, you know what, I don't need 10 grand of that, I thought I did. You can pay that back and it will go back into the line of credit. Okay, so you can actually refill the line of credit to its original amount. That obviously is a good thing because you never know what's going to happen down the road. You might have your car break down, you might need a new car, you might need to pay for your grandson's tuition. You can take that money back out anytime you need. So part of this video is just to dispel the fear of an adjustable rate reverse mortgage, because it does give you more money, more options on how to spend the money and where to keep it as far as the line of credit, term payments, 10-year payments, and also they do have that rate cap, which is 5% above the start rate. So that's relatively low. It may be a little bit higher than that fixed rate, but remember, the adjustable rates are probably going to stay low for a while, so you'll be saving money over time, whereas with the fixed rate, you'll immediately be having to pay the interest or owe the interest on that 5% loan right away, all of it, the whole lump sum. Whereas with the fixed rate, or the adjustable rate rather, you can choose as much as you want. You could take none of the money out, leave it all in the line of credit, and not be charged interest on anything you don't spend. I enjoy making these videos for you. I hope they're informative. Again, my name is Brandon Webb for USA Reverse Mortgages by iReverse. Please give us a call to learn more. Thank you. Have a wonderful day.